Most people believe markets react to headlines. They assume prices move because of obvious news. A policy statement, an economic report, or a geopolitical event that everyone can see at the same time. That belief is comforting, and it's usually wrong. Markets rarely move because of what is widely known. They move because of what changes beneath the surface before most participants notice it. By the time a headline explains a move, price has often already adjusted. This is especially true in highly liquid, globally traded markets like gold and silver. These markets don't wait for consensus. They respond to shifts in conditions that affect capital flows, currency demand, and risk positioning, often hours or days before the narrative catches up. When prices move sharply, the instinctive reaction is to ask, what bad news just happened? A more useful question is, what changed that most people weren't watching? Understanding that distinction matters. It's the difference between reacting emotionally to price and interpreting price as information. Today's market movement wasn't simply about fear or panic. It was about a change in underlying conditions that altered how capital was allocated across assets. Those changes don't announce themselves loudly. They reveal themselves quietly through correlations, liquidity shifts, and relative strength. If you want to understand what just happened, the focus shouldn't be on the drama of the move. It should be on what the market noticed before the headlines did. On January 29th, 2026, precious metals experienced a sharp intraday price decline over a short time window during U.S. trading hours. Gold, which had been trading near recent highs earlier in the session, declined rapidly within approximately 1 hour. Silver followed the same direction, but with greater percentage volatility, consistent with its historical behavior relative to gold. The speed of the move was notably faster than typical daily fluctuations observed over the past several weeks. The decline occurred after a strong prior advance. Over the preceding month, both metals had posted substantial gains, placing prices well above their levels from late December. This meant that, entering the session, positioning reflected elevated optimism and increased exposure, particularly in derivatives and leveraged products tied to metals. From a timing perspective, the move unfolded during a period of high market liquidity, suggesting that the decline was driven by active repositioning rather than an absence of buyers. Futures markets showed accelerated trading volume as prices moved lower, indicating increased participation rather than disorderly market failure. Compared to last week, the change was not directional trend reversal, but a sudden repricing within an existing trend. Compared to the prior month, prices remained significantly higher even after the decline, highlighting the magnitude of the earlier rally. Importantly, there were no confirmed announcements of new monetary policy decisions, emergency interventions, or unexpected geopolitical events released at the exact moment of the price move. The decline aligned with shifts across correlated markets rather than a single asset-specific shock. In summary, the move was fast, occurring within roughly 1 hour. Both gold and silver declined, with silver showing higher relative volatility. The decline followed a strong multi-week advance. Trading volume increased during the move. No single headline fully explains the timing of the adjustment. These observations establish what happened without assigning motive or projecting outcomes. The next step is understanding why these facts matter and how cause and effect dynamics operate beneath the surface. Short, sharp declines in gold and silver matter not because of the price change itself, but because of what they reveal about market mechanics and capital flows. At the first order level, precious metals are highly sensitive to changes in currency strength, interest rate expectations, and liquidity conditions. Gold and silver are priced in US dollars. When the dollar strengthens relative to other major currencies, the same ounce of metal requires fewer dollars to purchase. This mechanical relationship does not depend on sentiment. It is a function of pricing and capital allocation. During the session, movements across currency markets, particularly strength in the US dollar relative to peers, coincided with the decline in metals. This relationship is well documented historically and frequently observed during periods when interest rate expectations shift toward tighter financial conditions. Higher expected yields on dollar-denominated assets increase the relative attractiveness of holding cash or short-duration instruments, reducing near-term demand for non-yielding assets such as gold and silver. At the second-order level, positioning amplifies price moves. After a strong rally, markets tend to accumulate leveraged exposure through futures, options, and margin-based products. When prices reverse quickly, those positions may be forced to reduce risk mechanically. This does not require panic or discretionary selling. It is often rule-based. As margin thresholds are reached, positions are reduced automatically, adding momentum to the move. Silver's behavior deserves special attention. Unlike gold, silver serves both as a monetary asset and an industrial input. More than half of global silver demand is linked to manufacturing applications, including electronics, energy systems, and industrial components. As a result, silver typically exhibits higher volatility during periods when global growth expectations are reassessed. When uncertainty rises around industrial demand, silver tends to react more sharply than gold, both upward and downward. The broader implication is that price declines driven by macro and positioning dynamics are not statements about the long-term value of the asset itself. They reflect changes in short-term incentives for capital holders. Investors focused solely on the headline move may miss the underlying process, a shift in relative attractiveness between currencies, yields, and risk exposure. Who is impacted first? Short-term traders, leveraged participants, and derivative holders experience the immediate effects. Long-term holders of unlevered positions are affected primarily through mark-to-market valuation, not through forced decision-making. Understanding this chain reaction helps separate structural signals from temporary adjustments. It clarifies why sharp moves can occur without any single dramatic news event, and why interpreting price in isolation can lead to incorrect conclusions about what actually changed. Periods of sharp, short-duration declines in precious metals are not unusual, particularly during broader upward trends. History shows that these episodes often occur after extended advances, when positioning becomes concentrated and markets grow sensitive to relatively small changes in macro conditions. Looking back at previous cycles, similar setups have appeared during moments when expectations around monetary policy, currency strength, or global growth shifted over a compressed time frame. In those instances, price adjustments tended to happen quickly, reflecting repositioning rather than a reassessment of long-term fundamentals. What matters most in historical comparison is not what happened after those declines, but what conditions existed beforehand. Typically, the common elements included strong prior momentum, elevated speculative or leveraged exposure, high sensitivity to interest rate expectations, correlated moves across currencies and commodities. These similarities help explain why rapid corrections can occur without a corresponding change in underlying supply and demand fundamentals. However, history is most useful when it highlights differences, not just similarities. Today's environment differs from prior episodes in several important ways. Global financial markets are more interconnected, positioning data is more transparent, and central bank communication is more frequent and more closely monitored. This increases the speed at which expectations adjust and the speed at which prices respond. Additionally, the composition of market participants has evolved. Algorithmic and systematic strategies now account for a larger share of trading volume, particularly in futures markets. These participants often respond to changes in volatility, correlations, and momentum rather than narrative or valuation. As a result, price movements may appear abrupt even when driven by predefined rules. Historical context, then, should be used to temper emotional reactions, not to draw direct conclusions about future outcomes. Similar conditions in the past led to a range of results, depending on how subsequent macro variables evolved. Some declines marked temporary consolidations, others preceded longer adjustment periods. The key takeaway is that sharp moves themselves are not evidence of regime change. They are signals that the market is reassessing risk under updated assumptions. Whether that reassessment stabilizes or deepens depends on developments that unfold after the move, not before it. Professional market analysis is less about predicting a single outcome and more about mapping plausible paths based on how conditions evolve. Rather than anchoring to certainty, it is more useful to consider scenarios, each defined by observable triggers and constraints. Bull case, strength resumes. If financial conditions ease relative to current expectations, then precious metals could regain upward momentum. This scenario would likely require a combination of stabilization or softening in the US dollar, lower or plateauing real interest rates, improved confidence in global growth expectations, reduced volatility across risk assets. Under these conditions, capital may rotate back toward assets that benefit from currency debasement hedging or long-duration exposure. In such an environment, prior price declines would be interpreted as a temporary repricing rather than a structural shift. Importantly, this outcome does not depend on new extremes. It depends on the absence of further tightening pressures and the market's ability to absorb recent volatility without cascading effects. Base case, consolidation, and repricing. If macro conditions remain mixed and policy signals remain ambiguous, then the most likely outcome is a period of consolidation. In this scenario, prices fluctuate within a broad range. Volatility gradually compresses, leverage is reduced across futures and options markets. Trading becomes more selective and less directional. This environment reflects digestion rather than direction. Markets recalibrate expectations without committing to a strong trend. For investors, this often feels unsatisfying. Price does not confirm either bullish or bearish convictions. Historically, these periods serve a functional role. They allow excess optimism or pessimism to be worked off while preserving optionality for the next directional move. Bear case, trend disruption. If financial conditions tighten further, then downside pressure could extend. This would likely require sustained strength in the US dollar, rising real yields, deterioration in global growth indicators, increased demand for liquidity over duration. In this case, capital prioritizes yield and safety over hedging and optionality. Precious metals, which offer no yield, face headwinds in such an environment. Price weakness would reflect opportunity cost rather than a loss of relevance. It's important to note that this scenario implies trend disruption, not necessarily long-term invalidation. Even in bearish conditions, markets typically overshoot before stabilizing. Across all three scenarios, the unifying principle is conditionality. Outcomes depend on how observable variables evolve, not on narratives or emotional reactions. By framing possibilities rather than certainties, investors preserve flexibility and reduce the risk of decision-making driven by short-term noise. When markets move sharply, the most valuable response is not to react to price, but to monitor the indicators that influence price behavior. These variables provide context for whether recent moves are likely to extend, stabilize, or reverse. US Dollar Index, DXY. The dollar remains a central reference point for precious metals. Sustained strength in the DXY typically reflects tighter financial conditions and higher demand for dollar-denominated assets. A stabilization or rollover in the dollar often precedes improved performance in gold and silver, while continued strength can act as a headwind. Treasury yields and real rates, nominal yields matter, but real yields, adjusted for inflation expectations, are more informative. Rising real rates increase the opportunity cost of holding non-yielding assets. Monitoring movements in Treasury inflation, protected securities, and also TPS, provides insight into whether metals are facing structural or temporary pressure. Inflation data, CPI, PCE. Inflation metrics influence expectations around monetary policy. Softer inflation data can shift rate expectations lower, supporting metals, while persistent inflation can reinforce restrictive policy. Importantly, markets react not to the data itself, but to how it compares with expectations. Liquidity and volume patterns help distinguish between forced repositioning and discretionary selling. Elevated volume during declines often signals mechanical adjustments rather than long-term distribution. Declining volume during subsequent price movement can indicate stabilization. Futures open interest and positioning changes. In open interest reveal whether money is entering or exiting the market. Falling open interest during price declines suggests deleveraging rather than conviction-based selling. This distinction matters for assessing follow-through risk. These indicators don't provide certainty. They provide structure. By focusing on them consistently, investors can replace emotional responses with a process, one that adapts as conditions change rather than reacting to every price fluctuation. Market volatility often feels urgent, but urgency is rarely the same as importance. Short-term price movements can be informative, but they are not directives. They reflect changing incentives, not definitive conclusions. What matters most is maintaining perspective. Risk management, position sizing, and time horizon should guide decisions more than intraday fluctuations. Markets will continue to move in cycles of expansion and contraction, and no single session defines a long-term outcome. Periods like this test discipline. They reveal whether decisions are driven by process or by reaction. A structured approach, grounded in observable indicators rather than narratives, helps reduce the likelihood of costly mistakes. This isn't investment advice. It's simply how I'm reading the market right now. Patience, preparation, and flexibility remain essential. Over time, those principles matter far more than trying to predict the next move.